Joining us now on the markets for the week ahead, Barry Knapp, managing partner at Ironside Macroeconomic, and Megan Horniman, Director of Portfolio Strategy at Verdance Capital Advisors. I guess I'll start with you, Megan, because you seem, we're doing a postmortem on Jackson Hole. And you seem to think that Powell effectively separated the tapering from rate increases, and that could be a positive and just in terms of allaying fears in certain market participants, right?
Yeah, absolutely. I think he did. He didn't surprise markets. This was what Becky alluded to earlier. He's definitely leaning more towards the dovish camp here. He's reassuring markets that we won't raise rates anytime soon, but the economy can withstand some tapering. So I think that is supportive for risk appetite and the equity market long term.
Barry, I think that, and I don't know what I'd do without the op-ed pages of the Journal, but they make me think, and I like to think on a Monday I need a little help, shaking me into, a new week and everything else. But talking about Powell, that this was really a political speech and a sales job to get another 4-year term. But in talking about what Powell said, I think the Journal agrees with you to the extent that we may be a little behind the curve already. He attributes inflation to transient things, but the inflation in the last 6 months has eaten away more than what we've gained in wages. It's already eaten into low-wage workers. So we're going to go through the same cycle where we stay low. Low-wage workers are the ones hit by inflation. People with assets are the ones that make money because they stay at zero and assets get marked up. So income inequality gets worse. And then we get another round of, we got to raise taxes, we got to do income redistribution and everything else. And the Fed takes no responsibility for it.
I thought the most fascinating part of his speech was when he talked about learning the lessons from the 1950s. I've written a lot about how this period is actually like the 1960s, where at that time the Fed thought that they had learned the lessons of the 50s. We had 5 recessions after World War II. They were very focused on inflation. JFK got elected. He appointed a number of Keynesians into the Fed. The emphasis changed from inflation to employment. Early on in the 60s, it was a pretty good period for equity markets. It was a pretty good period for nominal growth. But eventually, by around about 1967, as you intimated, LBJ was starting to tax their way out of the growing deficit problem, and inflation was getting out of control. So I just thought that was all very curious. I mean, my message here has been the Fed is going to have to taper sooner rather than later. I think they'll do it in September after a stronger than expected employment report, and again, another round of very strong house prices on Tuesday, which is one of the real reasons that they should be tapering. But through the cycle, they're going to be behind the curve. And I think the Journal was probably onto something with the idea of Powell just trying to position himself such that he could get reappointed. I didn't think he was going to really give us a signal that they were going to go in September at Jackson Hole anyway. He's not likely to pre-commit for the entire committee, but I think it's coming in set.
Well, Megan, to some extent, the federal government needs a willing partner in the Fed to get some of these things paid for that they say it's paid for. We know it's not really paid for. So we know how we're going to finance this $3.5 trillion or $5 trillion if you want to add everything in. And Jay Powell needs to be there as a partner to the government.
Right. He's got to keep interest rates, even though I think one of the bigger risks to the market right now is in the interest rate market because their yields just haven't moved, even with the good economic data. But at the same time, you're exactly right. The federal government needs a dovish person in the Federal Reserve because of the fact that we cannot finance the amount of debt that we've taken out if interest rates spike significantly higher from here.
And just because they haven't doesn't mean they won't.
Exactly. And that's the thing. They tend to move rapidly and when least expected. And I think that we're due here for just looking at where we are. We've talked about inflation. Even though growth has probably peaked from a growth rate level, we're still looking at really solid economic growth over the next few quarters. Interest rates are just not justified where they are right now. Once we start to get people back to work, I think that's something that could also push interest rates higher. So I think that's the bigger risk right here in the market.
Shepard Smith here. Thanks for watching CNBC on YouTube.